Richard, Aberdeen Asset Management, the UK-listed fund manager, reported a quarterly update today. They had outflows more than expected, and the shares were down fairly sharpish. Tell us a little bit about what's going on.
Okay, shares fell 70% after it said that it had net outflows of nearly £10 billion. That makes more than 20 billion this year and takes their assets under management down to 307 billion. Now, some of that's obviously forex changes and things like that, but basically the trend is down. This is now their 9th consecutive quarter of outflows from equities funds.
Okay, all right. So they are a fund management house that's known for their Southeast Asia and emerging market fund managers, really, and that's been their focus for a long time. Is it time for them to start thinking about maybe diversifying a little bit away from this? I think they have been moving in that direction, right?
It is, but for heaven's sake, don't let them start thinking of giving up their current investment style, the old bottom-up approach that's brought them success in the past in Asia and emerging markets. But yes, diversification, they bought Scottish Widows Investment Partnership, and they've integrated that, and that's brought some cost savings. And they've just announced the completion of 2 smaller acquisitions, which probably offer less scope for cost savings. But diversification is not going to be a quick thing, so it's no quick fix. They must just carry on doing more of the same.
Right, but so I mean, that dividend yield is now it's 5%. It's not insanely high, but it is high. It's rising. Can they afford to pay this dividend? Did they need to cut costs?
They do need to cut costs.
I think you said that they're a little bit high.
I've just had a look at the HR bill. 35% of every pound of revenue goes out on staff costs. That seems subjectively high when you add on another 20 of costs, and the 35 has stayed the same.
So it's 55%
55 altogether.
Costs,
so that's stayed the same. I think there's scope there for some cutting. On the dividend, it's twice covered at the moment. They've committed to a progressive dividend. It's a question probably of just paring back a little bit on the dividend increases. Don't go gangbusters at 20% increases. Just pare that back. You can still make it progressive by paying a penny more.
Okay, so dollar's still going up. Emerging markets, Southeast Asia tends not to do very well when the dollar is going up. What should investors do with Aberdeen Asset Management shares?
Stick with it if you like the dividend, but on the whole, don't go out rushing to buy them. They're on 11 times earnings, 2016 earnings for a reason.
Okay, Richard, thanks a lot. It's great.